SMC trading strategy that I'm about to share with you could genuinely make you a profitable trader. Step-by-step trading plan on how you can actually execute this trading strategy. Let's get into step number 2. Step number 2 will be identifying areas of liquidity inside of your trading range. Now, bear with me just a moment. It's actually very, very simple. You see, we've just gone over market structure and we've established that we are bullish, right? So we're bullish, we're looking for longs. Here is our protected swing low, because this right here is the low that broke the previous high and put in this high right here. So we have this right here as our protected swing low, and we have this right here as our weak high. So in a nutshell, we already know we want a long. We want a long above this low, and we want to sell that long back above this weak high. So we have our directional bias. Now what we need to do is we need to identify all the key areas of liquidity that sit inside of this trading range that we must avoid at all costs. Because if you don't spot the liquidity, you will be the liquidity. And so the most common form of liquidity is ultimately going to be forms of equal lows, equal highs, Asia session high, Asia session low, or old highs and old lows. That is pretty much it. So anywhere that there is likely to be somebody's stop loss, right? So if we look at this right here, this is the exact example and scenario that we're going to go with. Here in blue, we have the Asia session range. Now, for those of you who know me and you've been watching my content, you know that I love the Asia session range. I love to use the high and the low as liquidity. On top of that, so we're going to map out our Asia session range, right, which is right here. So that's a pocket of liquidity. We have the Asia session range low as another pocket of liquidity. We have an old high here in the form of this high right here that acts as liquidity. We have this high in here, which again acts as liquidity. We have equal lows in here, which all act as liquidity. Now you may be asking, why are they liquidity? Let's dive into that. So what is liquidity? In a very short, brief description, liquidity stands for obviously money, right? Fluidity of money. And ultimately, when we're looking for liquidity, all we care about is where are the stop losses, where are the take profits, and where are the entries. Because every time one of those things happens to a trader, that is liquidity coming into the market, right? So for example, if you have an order placed, then when that order gets triggered, you will either enter buys or sells into the market. So money flows into the market. When you get stopped out, so when you hit a stop loss, that stop loss doesn't take you out of the market. It actually puts you in the market in the opposite direction, right? So for example, if you are looking to long the market and your stop loss is down here, when price hits that stop loss, this triggers as a sell position, right? So we have stop losses, entries, and then take profits are exactly the same. If you're, let's say, shorting, right, and your take profit is here, well, when you hit that level, that is going to activate as the opposite side of this. So you will buy back the position and you will take the piece in between, right? The speculative profit. That is liquidity. So now you have to ask yourself, where do people put their stop losses? Where do people take their profits? And where do people get into trades? And the most common places for that is things like trend lines, equal lows, equal highs, time-based highs, external swing highs, right? These are all areas in which people are looking at taking profits, getting into their trade, or stopping their trades in a loss, right? So if we look at this picture right now, this is what I see personally. I see we have this internal structure that a lot of traders will be looking at. And when you see this internal structure get broken, right? So we go high to low, a lot of traders are looking at that and they're thinking that now it's time to short the market. So if there are sellers that are going to get involved in these levels in here, where are they going to put their stop losses? They're going to put their stop losses up here. Okay, so that's one form of the market. And then you have, let's say, price coming in here and pushing out like this. So we're coming into London session now, and there are some traders that are looking at this and they're saying, oh, look at this. We have this double bottom here, right? So therefore, that to me says that price is going to trade higher. So there are two types of traders. There are the traders that are executed on the way up. And where do they put their stop losses? They put their stop losses here. They probably put their take profits up here at this high. And then there is another type of trader. The other type of trader says, I'm gonna wait for one more confirmation. And when price comes back down here, then I'm gonna buy. So I'm gonna put my entry here, and maybe I'll put my stop loss at this low down here, right? For example. So you can kind of see right now, again, another one could be, okay, well, we're short in here, price is put in this high right here, and then we've pushed out. So this is a temporary area of resistance. So I'm going to try and short the market here, and I'm going to put my stop loss here or my stop loss here. So again, in just this one short, brief piece of price action, you can already see how so many different traders will see so many different things and make decisions based on those things. And ultimately what they do is they put their take profits in, their stop losses in, and their orders in, and that all acts as liquidity. But what we want to do is we want to most of the time wait for everybody to be taken out of the market. So in this example right here, right, we have step number 2, we are pro trend. So we're looking to long, and we have buy side liquidity, sell side liquidity. So what do you think I would want to see? Well, I would want to see a run of the sell side liquidity because I want to be buying. So I want to buy into the sells because that's what smart money do. And then I want to target the buy side liquidity. I want to target these highs. I want to target these highs. And that would be what I would see smart money are going to do, right? Because if smart money need to buy, they will first sell into the pocket of liquidity so that we induce all of these sellers and they don't have to initiate so much capital to get to where they want to go to, right? Again, that is a very brief understanding of liquidity, right? Don't lose me. Let's go.